right, well, good afternoon, good evening, good morning, good whatever.
Whatever it may be.
Welcome to the October 2024 MSMF Wealth Management Client Podcast. I'm joined as always by Cody Redding. Cody, how are you, sir?
I'm doing great.
Jay Peters. Mr. Peters, how are you?
Hey, I'm doing good.
Superb. And what we're going to talk about today, gentlemen, we are getting to year end. So we want to finish strong and give our clients some year-end financial and tax strategies to consider. Probably won't apply to everybody, but want to give people a couple different ideas to think about. Certainly, you get these ideas, it resonates with you, give us a buzz. We're very fond of our financial needs cornerstones, so we're going to present that in that format today. The financial needs cornerstone starts with everyone's nest egg. So I got a couple of things relative to our nest egg. First and foremost, if you have children or grandchildren who are in college or about to attend college or even in some type of private high school, we can use 529 plans to help fund those expenses. There's different limits. I think it's $10,000 per year for primary and unlimited.
Unlimited for college.
For college, right. And contribution-wise, in the state of Missouri at least, you can, if you're married filing jointly, up to $16,000 per year, you can get a deduction on your Missouri tax return. And the one unique thing, some of you may know, some of you may not know, you can make a contribution and turn right around and take it out and use it as long as you end up with a copy of a statement that showed that that contribution went in there. Mm-hmm. So one day it goes in, the next day it can come out. So it is a way to generate a little bit of a additional tax deduction, which is a good strategy, and we've used it a lot. So if you got a question, give us a buzz. The next would be kind of the nest egg around your overall investment strategy, which if you're one of our clients, we monitor with you relatively closely. But you will be getting, as you all know, here into early 2025, your 1099 statements. And it isn't so much a strategy for year end this year, but potentially next year. It's been a pretty solid market year. So if we see a lot of capital gain distributions, dividend distributions, there may be a way looking forward into 2025 where we could have a little bit more tax efficient investment strategy. And those certainly are things that we look at on an ongoing basis. But if you were to get the 1099 and you're like, holy cow, I got to pay this on my taxes, we can take a look at that going forward in 2025. Thoughts, either one of you on that?
Yeah, I mean, especially after this year, the 1099s, they, depending on that, they could be pretty decent this time of year, just with the gains we have. But I think you're probably more talking about the IRA distributions.
And that too, we're going to get to that. Yep.
Yeah, out of there. Yeah, there's certainly, especially for inherited accounts and things like that, I think there's some cool tax planning you can do around with that.
Yeah, and what I would say is if you get a 1099 here in early next year and there's capital gains distributions, you're like, wow, those come with their territory when we have a good market year and make money. Okay. Unfortunately, in some prior years, the market hasn't been that great and there's a lot of trading in the funds. This is not one of those years. So, but yeah, you get those 1099 distributions or those statements in early 2025. We'll sit down and talk through those. So let's circle back to focus really here, Jay, on year end. And along with, it's not so much investment accounts, but specific type of investment accounts. There's a lot from a retirement strategy we can do when we look at the next 6, 8, 10 weeks.
Mm-hmm. Yeah, because these have a hard cutoff date of December 31st for a lot of these different things. So a couple things that we're talking to our clients and that we're thinking about right now is making sure if you need to take money out of retirement accounts, I'm talking about our favorite 3 letters, RMD. Boo. Required minimum distributions, right? And so, that's always a big project for us to make sure all of our clients are meeting them. And there's different types of RMDs and different reasons why you might need to take distributions. But just know that retirement accounts, for the most part, are going to have some sort of requirement to take things out. And it's usually by the end of the year. So making sure we can check that off before we turn the page for the next year. And then another thing that we're talking a lot, specifically in the fourth quarter, retirement accounts, tax planning, would be Roth conversions. Where are we looking with our income? Are we maybe lower than we anticipated, or are we are things changing out in the future? Maybe we can do some conversions where again, that's where we take money out of a traditional retirement account, so 401k, IRA, et cetera, and move it over to the Roth counterpart, where we pay the taxes today, and then it kind of grows tax-free after that. So there's some benefits for doing that, but now's the time to really be looking at that because it goes by calendar year.
Right.
The other thing that we really like to think about for retirement accounts would be if you're contributing to them, now's the time to start thinking about next year, can we afford to start saving some more towards it? And we were talking before we hopped on here, like how much should I be really shooting for to save? And just kind of a real quick, benchmark on this. Start with however much you're being matched if you're talking about a 401k, and then maybe try to increase that 1% at a time until you get to around 10 to 12%. Fair? Good with
Fair,
that?
very fair.
It's easy way to get to that target.
Yeah.
Imminently fair, my friend.
And then we wanted to also take note that in 2025, there'll be some catch-up contributions that are different. They're changing the rules on us. Thanks for that. In which case, if you were in the past 50 or older, you got to put more money into your retirement accounts. Well, now they're adding a second window of catch-up contributions. Does it have a name? I just thought about that. So we have catch-up contributions. Are these like super catch-up contributions?
Ketchup contribution?
Ketchup, like ketchup and mustard?
The Heinz contributions, maybe?
It's
Yeah,
just,
I don't know.
That's good. I wasn't ready for that.
But anyway, if you are, starting next year, if you are age 60, 61, 62, or 63, just those 4 years, then you can do this extra catch-up that we're talking about.
Wait a minute, how old?
60 to 63. Hey, you reached it.
Congratulations.
Yeah. Screw you.
You win by...
Ain't nothing. Just move on.
In which case, you can add even more than, the IRAs. You could put an extra 1,000 in. With 401ks, you put 7 normally. Now it's up to 10. But then even we're asking for clarification because with their formula, it might be more than 10. I'm not sure. So, but anyway, you can put in a little bit more if you're those 60, 61, 2, and 3. So, yay, new rules. And then there's other rules that are coming into play too around highly compensated employees too around that. So, heads up, never stops.
And we'll get into all that. Mm-hmm. But I think I'm going to ask you a question as it relates to this because before we get to the next section, I know we've all talked to our clients about this, but we're headed towards some new income tax rates. Mm-hmm. We know what we have next year. We think we know what we have for now in 2026. And that thing in November that we have coming up is going to dictate kind of what goes on. So when you talk about these required minimum distributions, they are in fact minimums. Mm-hmm. And so have you talked to your clients, particularly maybe those with inherited IRAs where you're encouraging them, let's take a little more under these lower tax rates because of uncertain future, or what are you advising there?
Yeah, 100%. And especially if you have another thing that's a little further on our list, if you want to like gift it to someone or you have special projects that are important to you, those different types of things. But yeah, if we know what tax rates are now and you're comfortable with it, it might make sense to go ahead and take out more than the minimum, to your point.
Right, and so there's still plenty of time between now and the end of the year to talk about taking more than just the minimum, or to your point, we love Roth conversions. It comes at a tax cost, but given what's coming in a couple of years or likely to come in a couple of years, we still have time to get that done.
Yeah, and the way I like to think about it is there's 2 ways to think about taxes. One is reduce the total amount of taxes you're paying this year, which is fine, but we are long planners. So how can we reduce how much taxes you're going to pay over your life or your kids' lives or your kids' lives? In which case, that's when these things start making more sense to go ahead and prepay taxes.
Right, great perspective on that. All right, so let's keep rolling. Jay, I'm going to stick with you. The next kind of corner on our cornerstones is protection strategies. So between now and year end, what's out there from this thing called protection strategies? What are we having our eyes on?
So it's October, and for a ton of companies, that's when they renew their benefits. So that means you might have gotten a big package where it's, here are all the new health insurance options and, employee paid life insurance and all those different things. So that's something that's already built in a lot of times to a lot of people's pay, and they already have access to it. So now's time to be thinking about that and kind of projecting for next year. So, get signed up for that now and make sure that that makes sense. A lot of times coordinated with that would be like a flexible savings account, an FSA. Keep in mind there's really two different types of those. One's for healthcare expenses, and the other one that a lot of people have access to and they forget or they don't know about would be the child care portion of the FSA. Remember with that, if you're already paying for daycare and you have access to that, why wouldn't you use that and just get tax-free money to pay for daycare? Heck yeah, let's do it. Now it's maxed at $5,000, I believe. In which case, I wish that would go up because I know mine's more than $5,000. But at least it's something, right? So knowing your benefits, that's a great way to set yourself up for protection next year. And then the other one that's kind of related but a little bit different, because with FSAs, you have to spend it in that year. So that's why this is time to really be thinking about it. And if you need to go on Amazon, they have a whole list of FSA eligible things.
Stuff to buy.
Stuff that qualifies, because you can't just spend on anything.
Right.
Has to be a qualified medical expense. So keep that in mind. FSA, use it or lose it. But then related, maybe next year it makes sense to do a high deductible plan and qualify for an HSA or a health savings account. So now it's not about spending, it's about savings. And we love HSAs because they are triple tax advantaged. You get a tax deduction for putting it in, grows tax free, and as long as you put it on a qualified medical expense when you take it out, it's never taxed. So pretty cool thing there, and you can carry that thing all the way through retirement. So HSAs, if a high deductible plan makes sense for you, definitely consider those.
It's a unicorn.
A unicorn.
It is.
There's nothing like it in the tax code.
Yeah. Triple tax.
Okay, awesome.
Love it.
Let's keep rolling. Cody, our next corner, kind of in our cornerstones, is legacy planning. And again, we're 10 weeks to the finish line. What can we do from a tax perspective, legacy planning, gifting issues that would make sense potentially between now and New Year's Eve?
Yeah, so I think number one is the gifting limit for the year. So you get that exemption gift, and I think, is it 14,000 for 2020? No,
I thought it was like
18.
Sorry,
Yeah.
way off. Going back a little
That's
bit.
a couple years ago.
Hey, I know your head's focused on number 3 coming along.
Yeah, I do have number 3 coming here. No, 18,000 per individual per person. So, give you an example. If you're, married, have a spouse, you can give one of your kids 36,000 because that's 18 from you, 18 from your spouse, and if they're married, it can go on and on and on. So you could really use that to your advantage. The big thing with that is there's no tax filing thing that have to be done if you stay at that limit or below. So that does have that deadline of the 31st by the time that you give them the check. So if you want to do it now and then do some again next year, now would be the time to do that. Donor advised funds. So, we have some clients that basically gifted money into a donor advised fund, and then there's their charitable intentions are named there and distributions are made out. To get those done by the end of the year, there are some requirements of the donor advised funds that I think about 5% or so has to be distributed per year. So we're coming up on that deadline, and usually companies are pretty quick with that. But as everything gets piled up at the end of the year, you probably want to get that in like the middle of December at the latest.
Right. So the donor advised funds, real quick, you can take a larger sum of money, make a contribution to that donor advised fund, get a current year tax deduction,
Right.
and then make those dribble out, if you will, those gifts to charity over a period of time. And
Right.
It can
And
be
invest the
any
account
number of
and-
charities you want, right?
Exactly.
Yeah, okay.
Or let it accrue, and hopefully, at the end of the day, your what you have to take out per year, obviously you can do more, will accrue, and that way you can give more charitable
Yeah.
distributions.
And we see those when people get inheritance, sell a business, what have you. Like the lowest number for one of our custodians is 100,000, I believe.
Yeah, I believe that's right.
So we see them in those scenarios. Very, very useful tool. But you also have to then in turn gift it out.
That's right. Yeah, you have to spend it at some point. And then there's the qualified charitable distributions, QCDs, which is a great way, especially with how the standard deduction is now, that you can actually make a charitable contribution. If you're, I think the age is still 70 and a half.
70 and a half. It's one of these things where
one of those that did not
they keep us in
change.
business because these age rules.
So if those of you that don't know what it is, at some point you have to start taking RMDs, which it used to match the age 70 and a half.
Correct.
And they just stuck with it on the QCDs. But if for those of you that don't necessarily need that money to live off of, you can basically take money out of your IRA up to $100,000 a year, gift it to that charity or multiple charities, and you don't have to pay taxes on that distribution from the IRA. So it's a great avenue for that's usually people's biggest assets or IRAs for them to be able to make a charitable contribution and not pay taxes.
Right. It satisfies their required distribution.
Yep, exactly. So I mean, from a legacy planning, those are probably the top three things that really need to get done by the end of the year if you're wanting to utilize that.
Super. Now, just in general, obviously legacy plan has a lot of tax implications there. Any other general kind of tax ideas that you have that you've coached your clients through?
I think the biggest ones we've had conversations on, like just going back to the inherited IRAs, because they changed the rules on that a lot. There's a finite time that for a lot of people they have to get the money out of the account, so 10 years. And yes, you're required to take some distributions along the way, the RMDs, but you don't also want to be left at the 10th year with a big balance that's going to put you up into a big tax bracket. So making sure that you evenly spread that out over the course of time, or hey, we know you're going to retire in 2 or 3 years. Well, let's just take the RMD for now, and then let's supplement your income using that since we know we have to pull it out.
All right. Same kind of thing we were talking about with Jay. We know what we have now for the next couple of years. Giant question mark, what kind of tax structure we're heading into.
Yep.
All right, super. Any other general tax considerations we should be looking at here?
Yeah, I think a couple that probably come to the top of the head would be if you're going to get a year-end bonus, and you haven't fully utilized maybe making some contributions to the 401k. Well, maybe before you get that bonus, up the contribution to your 401k so you can max that out and utilize that. Obviously as long as it cash flows correctly for you.
Super.
Tax loss harvesting, or for some people maybe gains or a combination of both. But again, before those 1099s get kicked out in January and February, and unfortunately sometimes March for some of the custodians, you do have the deadline at 12/31 to utilize losses in the accounts and or gains to help with your tax situation for the next year.
Yep, and it's easy for us if someone's interested in that. They can call us. It's easy for us to run a report in their taxable accounts to see kind of where we are, what if anything we can do in effect before 12/31 to help out.
Yeah, I just did it for a couple of clients here earlier this week, and there's just everyone's situation's a little bit different, but there's always opportunity for that type of tax planning.
Super. Jay, final thoughts?
Yeah, one other thing to finish strong for the year. I know a lot of people are getting kind of shocked with how much they're spending. So it might be a good idea to kind of audit what your expenses are, check out those subscriptions. Do you really need 5 different streaming services? Just kind of taking a look at there and make sure that you're setting up next year to maybe save and do more of these things on this list.
Yeah, I would say that I recently, out of curiosity, did an auto pay audit to see on my credit cards.
Oh gosh, I don't even
and
want to
my
do that.
bank account what's on auto pay, because I'm not 100% empty nest, but I got one adulting in Nashville and one semi-adulting in Kansas City, and my God, I spent some money on those children on a monthly basis. So I'm just like, no.
You got your red pen out?
I would say my favorite red pen. I would say look at it, because you'll be surprised what you're paying for every month. You just don't realize.
And they keep upping the prices on everything.
Oh my
And
gosh.
next thing you know, you're spending so much money.
Ridiculous. Cody, final thoughts?
Yeah, I think probably one that we've had some conversations with recently. I think Missouri passed a new law that if you're age 65 or older, you
I'm
can,
not there yet, so don't look at me.
coming up for you soon. You can freeze your real estate property
Yeah,
tax. I believe.
absolutely. That's cool.
Property tax or real estate or
No,
both.
property tax.
Property
yeah.
tax.
Property tax. Okay.
very
So,
cool.
but it just doesn't automatically happen. Of course,
Right,
the
be
government
proactive.
says there's some legwork on your end, but just know that that's available. And I think there's at the county offices, they have dedicated people to help you with that.
Yeah, great idea. Cool. Gentlemen, excellent stuff. As always, you got any question on these kind of year-end strategies, to Jay's point, let's finish strong. Anything resonated with you, please call us, email us, use the text line. Feel free to share this with friends and family. They got any questions on their year-end strategies, they've expressed some concern about what they think the potential tax bill is that's coming. I think as we record this, it's October 15th. It's the deadline for individual tax returns.
It is.
Right? If you had an extension. So hopefully you got yours in. Mizzou's still in the hunt, Christopher. And the Blues got their home opener tonight. So let's go Blues. Have a great rest of the month. We'll look forward to talking to you before Thanksgiving. And again, reach out to us if you got any questions. Thanks for listening.